If you've ever wondered what a successful stockbroker's portfolio looks like, especially if they are CEO of a stock trading platform now, wonder no longer. We will try and find out. Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim, and joining us today is Ian Leong. He's the CEO of Tiger Brokers. Ian, thanks for joining us today.
Howie, thanks for having us today.
So I hear, way back in the day, when you were younger, you had always wanted to be a stockbroker. Why was that?
Well, it's like all of us, since we were kids, we always ask ourselves what we want to do when we actually grow up. So when I first started, I was thinking in terms of the civil service, scion, or even like, say, for example, doctors or, lawyers, for example.
Yeah.
Until one day when I was watching a Hong Kong drama, I was like, what profession is this? It's so exciting.
Which drama was this?
The Greed of Man, 大时代. So essentially, it caught my attention. So that was when I asked my mom. So she was telling me this is a stockbroker's profession. So it piqued my curiosity. The more I learned about it, the more intrigued I was, and the more I wanted to join this industry.
How did your mom describe it to you?
Well, she was telling me straight to the point, willing buyer, willing seller. Yes. So at that time, what happened was we still didn't have, like, say, for example, the internet era of things. Yes. So essentially, if let's say you want to take a look at what's the prices, essentially you call the stockbroker or you take a look at the newspapers, what was the opening, closing price the day before. So that was how she actually taught me to, buying and selling of the stocks via the newspapers at the time. Yes.
Right. And you never veered from it since figuring out that this was what you wanted to do.
The only disappointment I would say I had was when I first got to know this industry, they had the open outcry system. So to say that there was a pit, all your brokers, your remisers are in there bidding, buying and selling. So I told myself, I want to be in the pit. But when I was in secondary school, it changed electronic. Yeah. So, but nonetheless, I still joined the industry. So, yeah.
Now you are a stockbroker. What's it like doing the trades at that point in time?
To be frank, my very first trade, my hands were jittery. It's because my client was on the phone telling me what order to place. Yes, I'm trying to make sure it's not wrong. In the meantime, it was my very first one. I thought, yes, I joined this industry. Yes. So it was both excitement plus a bit of nerves.
Did the nerves and the excitement ever subside?
Oh, definitely. The more you do it, it's just like, a walk in the park itself. And it will come to a point whereby it's beyond helping clients to place trades, but also when it comes to helping their investment journey itself.
Was it different, dealing with people's money or your own?
When it comes to your clients' monies, you tend to be very objective. They'll tell you what are their goals, and from there you map it out for them. You'll tell them, like, say, for example, what are the rules, stop loss, and when to gain profit. When it comes to personal side of things, especially when you first start in the trade, it tends to get a little bit more emotional. Yes.
Would it be more greed or more fear, you think, with your own money?
Both, depending of, say, for example, the situation we are in. Greed is when the stock prices are going up, you feel that, it can go up even higher. Fear is when the stock prices are going down, you are lost in the market itself, whether should you cut loss or not.
Would you say then that's probably perhaps the biggest mistake that you still see people make today? Getting emotions involved.
Yes. Emotions always plays a part in all the decisions that we make. So FOMO, fear of missing out, it's a form of emotions itself too. Yes, fear after all. So if let's say you take these two out and become more objective, it's easier. But sometimes it's not that easy because emotions still plays a part. We are human beings after all.
Yeah.
Yes.
Plus the YOLO as well.
Oh, yes. A lot of, I would say, youngsters or new to investing, they tend to actually scared that this is the only bull run they will have in their whole lifetime. Nah. Typically, you have three. After you're in your 20s, 30s, typically you should have 3 bull runs. So you miss out the first one, it's fine. Essentially, it's always about, not using emotions to invest, but being objective, stay true to the end goals that you like to achieve.
Then what is your own personal investment philosophy then, Ian? Do you chase the highs, sell at the lows, that kind of thing?
Oh, I was very good at it last time.
Yeah.
Always chasing the highs, always selling the lows at that time. So I was much younger. I'll be frank with you. I tend to be more impatient when it comes to the stock market. I want the fastest returns one could actually look for. So after paying for a few lessons itself, so essentially that was when I told myself, when I actually look back on hindsight, what went wrong was actually my emotions making the decisions.
Oh.
So ever since then, I always believe in DCA, dollar cost averaging, because essentially it helps me in my goal.
Dollar cost averaging, really?
Yes.
So that's pretty basic. Someone as expert as you still follow DCA.
I still
Why
follow
not
it.
more, complicated or complex investment strategies?
It's just like in business. I mean, say for example, in the F&B business, you can actually do a Michelin 3-star restaurant. You still can make money. Or you can actually go with the masses, franchise, like just like McDonald's. Yeah, not much margins, but you still can make money itself. Sometimes the simplest strategy works instead of the most sexy one.
Yeah.
Yes.
Okay, you brought up food, right? So I took a look at your website, and the Tiger Trade Experience quiz was asking people what sort of investors they might be, akin to cooking, or what sort of sauce might they be, what one's special sauce could be. So there are a few. It's the dependable salt, the sharp and punchy wasabi, and something bolder like sambal chili. What would you say is your secret sauce?
I took it twice.
Okay.
Once when this quiz started, and once just this morning. Both times, sambal chili. For sambal chili, essentially I take calculated risks, and I tend to be unpredictable. But it's contrary, it's ironic to dollar cost averaging, isn't it?
Yeah.
Yes. So as mentioned, emotionally, this is who I am, what I am, and this is how I actually, like say, for example, grow the business itself. Taking calculated risks to make sure that we can grow and being unpredictable. So essentially, my competitors are being caught off guard. But when it comes to the investment space side of things, it's different. We need to be more objective. After all, it's not about emotions. It's about fulfilling your goal at the end of the day.
Okay.
If you ask me personally, I only have two goals when it comes to investments. One for retirement, of course. The other one for my kids' education itself. So both goals tends to be more longer term horizon. Say, for example, 10 years from now. So time is on our side. So this is why DCA dollars cost averaging actually work for us, is because essentially markets in general on a long-term basis is always on the uptrend itself.
So what do you feel are some of the biggest misconceptions that investors might have that, DCA very basic, or basic investment strategies are basic? They're not really, are they, actually?
It depends on your objective. Yes. So say for example, in my instance, retirement, education, boring works.
Yes. Okay.
But if say for example, I want to buy a new car in the next 6 months. I need something, a return, say, in a shorter time frame. Yes, perhaps boring may not work. Yes.
When did you start investing, though?
Well, my very first trade was back in 2010 when I joined the industry. That time I was 25.
Right. So you were 25 when you first started, and now you are of a certain age with a lot more experience. What would you have told your 25-year-old self if it were possible to give them advice?
One word: pace. I was impatient.
Oh.
Yeah. I see it more of a sprint instead of a marathon. So I made a lot of mistakes at the start of my career when it comes to investing side of things. Say, for example, earnings season, particular companies' results are coming out. So the day before, you'll be thinking, okay, betting on it, that you'll go up or go down. Yes. So it's the wrong philosophy when it comes to investments itself. Like, I won't call it investments, it's speculation. Yes. So I burned hard at that time. So looking back, I told myself, no more. It's more about investments. Yes, no more speculation. So looking back, I would rather I pace, see it as a marathon long term instead of a short term.
Now that you're CEO, though, do you still trade stocks every day?
I won't call it trade stocks. I'll call it invest in stocks. Trade, my own definition, I'll put it in terms of a more shorter horizon. Probably days, weeks, or even a month. Investment, longer Longer term, 6 months, a year, yes, I still do so.
What does your portfolio look like now?
It used to be predominantly in banks. Now, I would say it's about, say, 60% in banks, another 20% in AI stocks, and another 20% in ETFs. ETFs that tracks indices,
Right.
like say your NASDAQ, STI, Chinese CSI 300, so on and so forth.
All right. Let's talk about the volatile. Market's always volatile, right? Where in the recent past has DCA really proved its worth for you?
Oh, simple. In April, and also in just last week itself, when the markets actually moved down. So why I mentioned that it actually worked for me, it's even though market actually tanked by 10, 15, 20%, my average cost price is still lower. Yes, because I actually invested on a long-term basis.
Right.
Yes.
That prevents the knee-jerk reactions one
Correct.
might have, right, when markets tank.
Yes. I mean, end of the day, it's the stocks that I buy are fundamentally sound. They are like, say, for example, your banks, good companies. So instead of, say, for example, when the market turns, it goes down, instead of you selling, you should be buying more, isn't it?
Yeah.
Yes. So most of the stocks, I would say 70% are also dividend yielding. So when it actually drops down, my cost price is lower. My dividend yield, it's higher itself too. So in fact, instead of selling, I'll buy more.
Yeah.
The only time I will sell, it's if let's say you reach the 52-week high.
Speaking of sound companies, let's talk about the Magnificent Seven. That's always been a staple for people, but these days, some are saying they're no longer relevant. AI is coming into the picture, so these big AI companies seem to be, shall we say, the companies du jour, right? What is your take? I mean, how bullish are you on AI?
To me, I always believe in technology, AI included. So, like say, for example, in the States, on NASDAQ itself, you have hundreds, even thousands of AI companies.
Yeah.
But end of the day, it's if you believe in a particular story, nonetheless choose a company to invest in which is fundamentally sound.
Yeah.
Yes. There are two kinds. You know, we can actually, like say, for example, AI, we go with NVIDIA, for example. Yeah, it's fundamentally sound. But there are also other companies that tends to be smaller, not that sound, but returns it's a few times of your initial capital. So it's more of speculation, should I call it. So personally, for myself, I always believe in investing in something that you believe in. The key word is invest, not speculate.
It's sounding like emotions are the ones that get people into trouble, freak out, panic, that sort of thing, right? So how are you navigating the ups and downs?
Honestly, I have a checklist. I literally
how does
have
that
a
work? Okay.
checklist. So each time, like say, for example, I want to enter a position or exit a position, I'll see whether are the boxes being checked. Yes.
Give us an example of what's on your list.
Okay. First and foremost, it's the counter, the stock that I actually want to enter. Is it fundamentally sound? Is it in my like say, for example, pre-selected list of counters itself? That's one thing. Okay. Second thing, it's is it was there a drop in prices? Like say, for example, was there a drop in price for the last 5%, 10%, or 15% for me to enter itself? Last but not least is, do I feel that not entering now will be a bad mistake? If I check the last box, that means emotions are coming in. Essentially, I always tell myself, apart from investing on a periodic basis, on the counters that I believe in on a monthly basis, when I want to enter more, yes, what's the reason for me to enter? Is it because it's going up or because there's a retraction, that's why I'm entering? Same thing for selling. Is it because that the prices are falling, that's why I want to sell, or the prices are hitting 52-week high, that's how I want to sell part of my position to take in profit?
Last piece of advice you have for somebody who, a few of them, one, hasn't invested, two, doesn't want to invest anymore, and three, never wants to invest.
Aye. First one.
What is wrong with you? What's wrong with you? What's wrong with you? No.
First one, have not invested
Yes.
before. Essentially, find a partner that can help you in terms of what you want to achieve at the end of the day. Be it in terms of, say, for example, a platform that you can DIY, or say, for example, one that have a sales force that can actually help you with it. Now, the second one is essentially a one that do not want to invest anymore, right? So if you have hit the end of your goal, please, by all means. But if you are still not at the end product that you're looking for, perhaps looking for a new partner will help you in that. The last one, sorry, I kind of miss it.
Never wants to invest.
Never want to invest.
My money is fine in the Milo Kong under my mattress. Don't want to invest. Yeah.
I see. Essentially, at the end of the day, it's what you want. So if you feel in the Milo Kong, it's fine, please, by all means. But never forget there is always something called legacy planning.
Ooh.
Yes. For yourself, your retirement, for your kids, and also your kids' kids. With inflation, the amount in the Milo Kong may actually get smaller as time goes past.
True. But this is how perhaps the more risk-averse or perhaps, dare I say it, older person might feel.
So we also do notice a lot of elder folks, they understand the concept of inflation and time value of money. So this is why they're going to fixed D, they're going to, like, say, for example, products that are actually safer, that, give you X% of returns at the end of the day. There is a misconception when it comes to investing in stocks that everything is, say, for example, risky. Not exactly. Say, for example, investing in certain good fundamental stocks, for example, only, like, say, for example, the banks, the 3 local banks, yes, it's one of them that actually pays you, on average, indicative 4% per annum. Yes. So these are ways that can actually help you to make sure that your Milo Kong of money stays relevant now and in the future.
A big thank you to Ian Leong, who is the CEO of Tiger Brokers. I'm Howie Lim. This has been Money Hacks by the Business Times.